Hi there. Thank you so much for your interest in the Blue Vikings Real Estate Income Fund. My name is Maria Zondervan. I am the CEO of Blue Vikings Capital, and I'm thrilled to have you here. So, let me tell you all about this income fund. So, first and foremost, it is a private lending fund offered to accredited investors. And I have to do the disclaimer. So please note that I am not a financial advisor. I am not an attorney and I am not a CPA. Those are all the types of people that you may wish to consult before engaging in any type of investment. So let me tell you a little bit about what the Blue Vikings Capital Real Estate Income Fund really is. So I mentioned private lending. So it is indeed a private lending fund that provides first position loans on short-term rehab projects. And by short-term, I mean usually 6 to 9 months. So companies use the loan funds for property acquisitions and renovations, and then quickly resell the properties for a profit. So you might know these people as flippers. You may have seen some of the flipping shows on TV where they flip the house. So they buy something that needs a lot of work, they do a bunch of renovations, and then they sell it for a higher price. Some people call it just rehab and resell instead of using flipper, right? So that's kind of what we're going after. But unlike direct private lending where your investment is tied to one loan on one property, your investment in the income fund is immediately diversified across all portfolio loans to mitigate risk. These loans are secured by a mortgage on the properties being purchased, ensuring a collateral backed investment. Our team services and oversees all the loan activities. So, all of that is done in house. So, it's basically a way for you to get monthly passive income from real estate loans. So, it pays 7 to 10% depending on how much you deposit with us, and that is paid out monthly. So, they're monthly distributions. The minimum investment is $25,000, and we do offer a 90-day liquidity option, which means if you need to get your money back out, you can do that with a 90-day notice. Usually it won't take us 90 days to get your money back, but if it is all tied up in loans, you may have to wait for a loan to get paid back in order to get that money, but no longer than 90 days. So here's a deeper look into how it really works. So first, an investor puts money into the income fund, right? They invest in that. The income fund then makes loan to real estate professionals flipping houses. Those borrowers, they borrow that money both for the purchase of the property as well as for the renovations that the property needs. While they have the loan, they're paying interest every month back to the income fund. And then when they resell the house, then they pay back the entire amount of the loan back into the income fund. Meanwhile, the income fund, they receive those monthly interest payments from those borrowers and they use those to pay the preferred returns back to the investor. The investor then, of course, receives those preferred returns from the fund, and then they choose to either withdraw that or they can leave it in there to compound. So you can compound those returns. And we'll talk more about that. So here's what the preferred returns look like. So again, the starting investment, the minimum investment is $25,000. If you're investing at that level, you're earning 7% on your money. Not bad. Try getting that from the bank. Not going to happen, right? So 7% on your money. If you are at $100,000 or more, you're up to 8% on your money. If you get to the $500,000 mark, then you're at 9%. And then we top out at 10% when you get over $1 million. Again, we do offer the monthly compounding option and we have the 90-day liquidity. And most importantly, we're paying these preferred returns to our investor before we even pay our own expenses or we realize any sort of profit. So the investors are at the top of the hierarchy. All right, so who can benefit from this sort of an income fund? Well, real estate investors love it because they know the power of real estate and they know that banks generally love lending on this stuff. So why shouldn't they? It tends to be a pretty safe investment, right? Medical professionals, really busy people, don't have time to be flipping houses themselves. Here's a way for them to be in the real estate game without having to do that. A lot of business owners, high net worth individuals, and high income individuals are all people that can benefit from this kind of thing. Now, you do have to be an accredited investor. And if you don't know what that means, it basically means that you meet one of two criteria. You do not have to meet both, it's one or the other. So you can either meet it by having a net worth over $1 million that is not counting your personal residence. So other income that you would have. So if you have, or other net worth items, I should say. So if you have money sitting in an IRA or 401k, that can count towards that. Cash value of life insurance counts towards that. Your stock portfolio, any other real estate investments you might have, if you have a business with a cash value, anything like that, even collectibles and cars and RVs, boats, all of that kind of stuff can count towards your net worth. So if all of that combined trips $1 million or more, then you can qualify as being a accredited investor as long as you're not counting that personal residence. The other way to qualify is by your income. So if you make $200,000 or more, if you are filing your taxes individually, or $300,000 if filing jointly with a spouse, and you think that income is going to continue for at least the next 2 years, then you also qualify as an accredited investor. So if you meet either of those criteria, you are eligible to invest in this fund. Congratulations. All right. So what is compounding interest and how does that work in this? So Blue Vikings Income Fund stands out by offering investors the choice of having monthly distributions deposited into their checking account or reinvested into their principal. Reinvesting allows for this compound interest where the distribution is added to the principal, generate interest now on both the original amount and the added distribution, leading to faster growth over time. So this is something most funds don't offer, but we're really happy to offer this to you. And you can see here on the graph what a huge difference that can make. So this is looking at someone who invested $1 million at 10%. So at the bottom there, you see the initial $1 million. Obviously, that hasn't changed there, right? And then the light blue section shows if they're just doing the interest and pulling that out every month. They're not leaving any of it in there. So then in total, they'll have made about $3 million here, or they'll have the value of their account of $3 million. So that includes the first $1 million investment. And then they pull about $2 million worth of interest, which is not bad. But if you leave it in there and leave it to compound in the same length of time, look where you end up. You end up at $7 million. So actually over $7 million, right? So it's hugely powerful. And that's why we're really excited to be able to offer this option to our investors. So here's what that looks like in actual numerical format if you're investing at a 7% or an 8% rate, right? So let's say you invested $50,000 at the 7% rate. After 10 years, so this is looking at a 10-year period, that will have doubled. You're over $100,000. And you'll see the effective annual return. So even though the return is 7%, because of this compounding effect, even the very first year, your effective annual return is 7.23%, right? And then it goes all the way up to 13.55%. So it's very powerful. Once you get up to that next level, you can get up all the way up to 17.01% effective annualized return. And now you're more than doubling your money. You're 100,000 turns into 222,000 just about, right? And then this is a look at the top tiers, the 9% and the 10%. Again, very, very powerful numbers here. You can get all the way up to 25.66% effective annualized return. So great way to make money on your money. Make that money work harder for you, right? So risk mitigation, let's talk about that. There's risk in every investment you make. We all know this, right? When you're buying stocks, you're buying a piece of a company. That company does great, you make great money. If it does lousy, you lose money. If it goes out of business, you lose all of it, right? None of us want that to happen. But every investment is like that. So if you're investing in real estate syndications, which you might be if you're on my website, right? I do a lot of syndications, a lot of bigger deals like that. They can have really, really high returns, which are amazing. But it does lock up your money for 3 to 7 years, depending on the business plan. And there's risk, just like there is with this. So it's all a give and take. And so we want to always balance that risk. We accept that there's risk, but we don't want to just say, okay, there's risk. Instead, we want to do everything we can do to mitigate it. So we have developed several leading safeguards to mitigate the risks that are entailed with lending. First of all, we want to make sure there isn't any inappropriate use of the funds. So let's say, for example, that we're lending $250,000 to somebody. Let's say they're going to use 200 of that towards the purchase of the actual property, and then they're going to use 50,000 for the renovations to be completed, right? We don't give them the full $250,000 right off the cusp. First of all, we're not lending 100% of what they're buying the property for. We want them to have some skin in the game, right? So they're going to put down at least 10% on the purchase price of that house, plus their closing costs and all of that. Plus, they have to prove that they have the money in the account to pay the interest payments every month. So we're going to look at that first. And in some cases, they may have to put down more than 10%. And then we'll give them the rest to the purchase of that. And we send that to the closing agent. They'll have that in escrow. Then to get the money for the renovations, again, we're putting that in escrow, and then they can draw from it as they prove that they've actually done the work. So they'll be sending in photos, or sending in videos, or sending in, or in combination with really the invoices from contractors if they're not doing the work themselves, right? And then we'll reimburse them for that. So they may have to lay out some of their funds to cover the time in between, but that's even more security for us, right? We want to make sure they have enough funds to be doing that. So it's not just our money on the hook. So that's how we assure there's no inappropriate use of the funds. Unfamiliarity with location. All right. We do not lend across the entire United States because we can't possibly know all of those markets. So we are in Florida. I'm currently in Orlando, Florida. I used to live in South Florida. Our COO grew up in the Tampa area, knows that area very well. We've lived in Gainesville, Jacksonville, all over Florida. So we're very familiar with these markets. And so we tend to want to stay and lend in the markets that we know. And because when it comes to real estate, it is location, location, location. That's always the key to the value of the real estate. But we don't just leave it to our own personal knowledge. We also rely on third-party tools for property data and evaluations. There's lots of great software out there that can give you crime rates on an area, can give you all sorts of information on the value of property there. So that's kind of the high end look where we look at it first just with our personal knowledge, and then we resort to the tools, but we don't leave it even there. And we certainly don't rely on the borrower's opinion of what this house will be worth when it's all done. So instead we get a broker involved. So we actually pay a broker, and they give us a broker priced opinion. It's called a BPO on every property that we lend on. So we have that third party saying, yep, this is what this property is going to be worth. And all our lending criteria will be based on that. All right, foreclosures. We hate the F word, right? We don't ever want that to happen. But despite best risk management efforts, occasional borrower defaults could lead to a foreclosure, right? We strive to keep this number low by focusing on repeat borrowers that have proven themselves, right? And proactively monitoring and addressing potential default issues early in the process. So we don't want to wait till there's a big issue and now it might be too big to overcome. So let's say, for example, that we go to do our monthly draws for their interest payments. So all interest payments are an auto pay system, right? So on the first of the month, those interest payments come in. If for some reason one bounces because of insufficient funds, we're not just going to try it again or send an email or a written notice of some kind. We're going to pick up the phone and call them immediately and say, what's going on? Was it just a mistake or is there an issue here? And then let's say they're like, oh my gosh, my roofer walked off the job, right? And I don't know what to do. Well, we're partners with these folks. Okay, we're in this together. So we're going to try to help them out. So I'm going to say, you're going to call my friend Todd, or actually, I'm going to call him for you. And I'm going to, he's a great roofer, and I'm going to make sure that he puts you on the priority list and gets your job done ahead of anything else he's got going on, right? We're going to do everything we can to help them out to make them be successful. And trust me, none of these borrowers want to default because they will be done in this business. The word spreads really fast if somebody goes into foreclosure, and they'll never get a loan again. So they don't want that. We don't want that. So we're working as a team to prevent that from happening. All right, well, we've covered a lot of information here, but let's hit some of the frequently asked questions. So despite our best risk management efforts, what happens if a loan actually does default? What happens then? So we do hold that first position lien with immediate rights to foreclosure. So if the payments are being met, we can foreclose. And once foreclosed, our team will then either wholesale that property to a well-known rehabber, or we have the option to rehab the property ourselves and then put it up for sale. And again, because we're not lending at the full amount, full value of that property, there will still be a profit there, right? Just a little extra step that we don't want to have to take, but if we have to, there we go. So do I have to compound my returns, or can I take out monthly distributions? Again, this is completely optional. You're not required to compound your monthly returns. In your investor portal, there will be an option to select monthly distributions or compounding of returns. And you can switch this selection on or off at any time. So you don't even have to like make one decision for the rest of your life, right? You can change your mind. You can change your mind. How does the liquidity option work? So I touched on this a little bit too, but the liquidity option allows you to request your initial investment out of the fund anytime after the initial 6 months. So again, our loans are typically 6 to 9 months in length, right? So we need to make sure your funds are in there for at least one loan cycle in order to pay those, returns that you've been earning. That's how you earn the returns, right? So you need to be in there for at least one short loan cycle, and then you can request the money out. There is no penalty to withdraw any portion or all of your investments. And when you submit your request, your requested amount will be returned to you as soon as possible, but no later than 90 days. So if we have it liquid, we just had a loan close out, then we can pay you right there. Maybe it's 2 weeks until one closes out or whatever it is, but no later than 90 days. So that's how that option works. Is my capital diversified across all the loans in the fund? Once again, yes, this provides lower risk than lending private money on individual assets, and using a fund is essential to reducing the risk since your investment is diversified across all of those immediately when you invest in the fund. So it's not just the loans from the time you invest forward, it's all of the loans immediately. So you have that diversification right off the bat. How do you vet potential borrowers? This is an excellent question that we get. We use the number of deals that a potential borrower has successfully exited in the past. So it doesn't count anything they've got going on right now. It's only what they have exited and prove that they've done well and pay back their loans and all that kind of stuff. And if we don't know them, we're going to ask for proof of that. So we're going to ask them to send in the HUD statements that shows what they bought the property for and what they ultimately sold them for. So, but all that being said, our main focus is always the asset, the house itself, because that's where the value lies. So that leads to the next question. What requirements does the asset have to meet? So the asset needs to meet our guidelines of 65 to 70% ARV. That's after repair value. So again, that's where that broker opinion comes in, right? Or that broker-based opinion. That's going to tell us what the value of that property is going to be when it's all fixed up and done. And we don't want to exceed our loan to exceed 65 to 70% of that. And 70% is just going to be for the most experienced of investors. Everybody else is going to be closer to that 65% range, right? Just to lessen any risk that's associated with that for us. My mouse has stopped working. Hello, mouse. Oh, no. Oh, there it goes. Sorry about that. All right, next question. How long does it take to start earning a return? Once you have signed your subscription documents and wired your funds, we will start working on placing those funds into a loan. You start earning a return as soon as your money is placed or at the 30-day mark, whichever occurs first. So as soon as that money gets into a loan, you start earning a return. Can I add additional funds after my initial investment? Yes, you can add additional funds at any time. If adding funds brings your overall balance up into the next tier, your entire balance will begin to receive the returns associated with that tier. And the same works there if you're doing the compound thing. And if that compounding bumps you into the next tier, your entire balance, all of it, not just the stuff that moves into that tier, but all of it will start receiving the returns of that next tier. Also, adding additional funds 6-month lock-in period. So no worries there. All right, that's pretty much everything. If you are ready to invest, all you have to do is head over to bluevikingscapital.com and hit the start investment button there, or apply to invest, I think it says. And but if you have additional questions, you can also set up a call with me, and we can do a one-on-one call, and we can discuss whatever other questions you might have. But other than that, thank you so very much for your time, and I hope to be investing with you. All right, take care. All right, so that is all there is to this income fund. So if you like what you saw, if this is of interest to you, you can head over to bluevikingscapital.com and start your investing right there. If you have additional questions on that same website, you can set up a call with me and we can get on a one-on-one so I can answer any additional questions you might have. So thank you so much for your time today, and I look forward to hearing from you.